Let's bring in Victoria Scholar in London. She's the head of investment at Interactive Investor. Welcome back to the program. Victoria, record low rates and hundreds of billions of dollars in cheap cash have been great for financial markets over the past year. What can we expect now that the Fed is preparing to taper it off?
Hey there. Well, essentially, this taper has been signaled for some time. We know that it's been coming. We've seen that inflation pressures are rising, and that's echoed by the Fed's projections last night. It's expecting 3.7% for CPI this year. That's up from its prior projection of 3% that it logged in June. And of course, that's way above its 2% inflation target. So it looks as though tapering is necessary. It needs to start winding back its $120 billion a month asset purchase program that's been in place since the start of the pandemic. So although there were concerns about a so-called taper tantrum and a sell-off in the markets, the fact that this has been widely signaled now means that the markets are likely to react in a less dramatic fashion. And that's why we saw the S&P 500 gain by about 1% overnight. And we've seen Europe gaining this morning as well.
Now, let's look at the U.S. economy, Victoria. Unemployment and inflation there, as you mentioned, remains above target and above pre-pandemic levels. What's the Fed seeing that could warrant a pullback?
Yeah, so there's some interesting dynamics going on in terms of what we're seeing for growth, for inflation, and the employment picture as well. The latest employment figures from August showed a massive pullback in terms of job creations. We saw about just over 200,000 job creations in August. That goes against a million in the prior 2 months. Also, the Fed said last night that it's expecting a slowdown in GDP this year and into next year. That goes against the forecast for higher prices and higher inflation levels. So it's a difficult dynamic that the Fed is having to grapple with in terms of rising inflation and dampening growth. And we're seeing this not just in the US, but across the world. We've seen a whole host of issues related to the supply chains coming out of the pandemic, which don't look as though they're going anywhere.
So we're losing all this cheap cash in the system. Victoria, what sector should we be looking at? What sector should investors be looking at if they want to find value?
Well, if you want to play this theme, essentially it's interesting to look at the banks, which last night were rallying heavily. We saw Bank of America and Goldman Sachs up by around 2.5%, JP Morgan also up by 2%. Of course, banks are highly correlated with the interest rate environment. We know that they make their money through their net interest rate margins. So higher interest rates are positive for the banking sector. One caveat to that, of course, comes from the risks that we're seeing in China with Evergrande, China's second largest property company, which could potentially spell some broad risks for the financial sector and also the global outlook as well, not just in China. So US banks and there could be other systemic financial risks involved.
All right, Victoria Scholar, we appreciate the time, Head of Investment at Interactive Investor. Thank you.